welcome to the Big Five. We are here in the city of Mumbai, right next to the ocean. It's an absolutely fantastic place to be, and we have a really great audience with us right here in Mumbai. And we also have with us some of the top financial minds in the country, and we're all here to try and get you the answer to that one question that you're probably asking yourself. Where should I invest my money right now? Where should I park it? I'm hearing all these reports about the Indian economy collapsing and the global economy collapsing and what's going to happen to the rupee and blah and blah. Diwali is coming. Diwali is a very good time to really think about making some investments. So should it just be gold or should it be equity? Or should I buy a house or what do I do? Put it all under the mattress. So we've got experts in the field, and I can tell you these are the top experts. So you should listen to them and they'll tell you what to do with your money. And we'll come back 1 year later and we'll see how we actually manage. Come back next Diwali. So it gives me great pleasure, and it's a privilege to have all of you with us. Balance between the different views you're going to hear. Roongta, CEO of apnapaisa.com. Thank you all so much for being with us. Why don't I get opening comments, and I want to dive into each of these in detail. What would you be recommending right now?
I would say three kinds of investors, right? You have a first kind of investor who just can't be bothered what his returns are, and let me tell you, there are a lot of investors like that, right? And then there are these investors who want exceptional returns from their investment, and you have third, the savvy kind. I think all these questions that we are answering are to this savvy kind of investors, real estate.
Actually, I'm not. The savvy kind of investor quite often knows what to do. They already have a sense of it. What should the first side do?
I'll tell you. I think the other two investors, the guys who are expecting exceptional returns, are bound to be disappointed. Because there is no economic instrument that will give you high returns at low risk. That does not exist. Clearly, that defies the principles of economics, really. So, I think if your expectations are not right, if you don't have realistic expectations, you're going to be disappointed. As to what to invest in, I think the key is, this is like food, right? You can't just have sweets, you can't just have, I think you need a dash of everything. What the proportion should be depends on who the person's constitution is, how much of an appetite he has. There is no one answer, unfortunately, for anybody.
And I think what you have just said is the correct answer, that every single person should have a mix perhaps of all these things, and the ratio of that should depend. So if you are young,
on my constitution, on my hunger, how much money I can spend, I think it depends on a lot of factors.
So if you are young, you have a long earning span ahead of you, you can take a lot of risk. Equity is perhaps, or maybe 60-70% in equity. If you're older, you can't take that much risk, then maybe 20% in equity and a lot more in the debt funds that you were talking about. That's essentially what you're saying.
It has to be a mix. Real estate, if you can afford it, I mean, it's a high ticket item, so if you can afford it, yes, it should be part of your mix.
In general, do all of you agree with that have a balance of everything?
Yes, yeah, absolutely.
Of course, there's no idea. Yes.
Put it at the end of the day. I would put it this way. I think the first house that you buy to stay in is not an investment. It's a consumption item. I would treat it as consumption.
Okay.
Take it when you can afford it. You made a commitment to a city. The transaction costs on real estate are horrible. So if you're just going to have 2 years or 3 years and then going to move on, it doesn't make sense. You made a commitment to the city. You can afford it. Buy what you can afford. I think people frequently, because of the availability of easy loans, take on more than what they can chew. So buy what you can afford.
And the whole world really collapsed thanks to that.
And it is not an investment. The first house isn't an investment. The second one is.
Okay. So therefore, can I throw another asset class in here right now, which frankly, if you ask me, you were saying a short while back that it's very difficult to find something that is both high return and low risk.
Not difficult, impossible.
Okay. You might just be having something which is available right now, which is in that category. Like you have these tax-free bonds right now, 8.5% tax-free, which is 12% return, and zero risk, where they've got sovereign bonds. So what's wrong with those?
Well, first, they're not sovereign bonds. I mean, they are from public sector units. They're not sovereign bonds.
The government backed when they're AAA.
I think it's implicit. AAA is the big thing. I think otherwise it's implicit. And please remember, Vikram, you're concentrating on people who earn more than 10 lakhs. It's 12% for people who have taxable income of more than 10 lakhs. Now, not everybody who's watching this show has more than 10 lakhs of
No, but
income.
it's still taxable, even if you're paying 10% tax.
So if you're paying 10% tax, your return is 9%. That's it. So, I mean,
For somebody who's in 33% bracket, it's a great investment.
it is a good investment. Definitely, it's a good investment. So, again, I think the point to yours is even for the same person, depending on what he is eating the food for, if he is preparing for a race, which means something long term for his retirement, he might have more of equity. If he is preparing for, say, his son's education, that might happen in 5 years' time, he has to have more debt. He can't. So, I think even for the same person, I think depending on what he is preparing, the answers will be different.
Okay. So let me come to you, Chirag. What go to the audience and get their sense of what they're really making of all. Let's just come to equities, which is the big thing. Whether it's mutual funds or whether it's directly in stocks. What would be your take right now on where the value is? Are there sectors in the stock market that are really attractive that people should be looking at? Or should people, especially small retail investors, just stay away from direct stocks and only buy mutual funds?
See, we
get all of your views on buying stocks.
So I personally think that stocks is a great idea. Okay, the right time to buy stocks is today, the right time to buy stocks was yesterday, and the right time to buy stocks is tomorrow. I think for a lay consumer, he should not try to time it. This whole business about that it is very cheap now, I think nobody knows cheap, nobody knows
systematic investment planning.
I think for most people who can't figure out whether the timing is right, or the only issue with systematic investment planning is it's boring. Okay, there's no
managing your money sometimes should be boring.
It should be boring.
It's far better to be boring than to be really poor and starving when you're retired.
And the boring people are the successful investors. I mean, people who have done systematic investments in the past, you look about what their returns have been. Okay, and there is no earthly reason. Okay, you can put a part of your money on timing based investments, which can be anything, which could be equity, which could be debt. Put a small portion. The rest of the money should be invested systematically, disciplined manner, decide it in advance and just let it go. I think that is the right way to invest for most people.
Okay. Even this boring systematic investment planning route is not something that you would recommend.
I won't. For example, person belonging to a salary class of mine who earns fixed sum from Government of India, I can't afford to. So how can I do as others?
That is what national pension system is. National pension system, 50% of it is going into equity systematically.
See,
why is it any different from investing it in a mutual fund?
I guess we have to give right information here. NPS, if you see the architecture, it's sensitive to age. For above 35 person who enrolls, according to NPS, your risk appetite is less. A large chunk would go into riskless assets.
Okay.
So that's a different scheme.
So it's age dependent. So what are you guys planning to invest in? Equity, raise your hands. Okay, real estate. Okay, let me just get, who's got the mic? Let me just get views on what you guys think is the best investment. Who wants to say something? Okay, down here, picking up the mic.
Isn't the gold ETFs would be a better investment, because then you can have you can gain two advantages from that. First is liquidity, which you don't get from gold, and then you can have the advantages of investing in gold as well. So
and third, you don't pay wealth tax. How about that? That's a third.
So basically serves two purposes.
Okay, let me get some more views from the audience. Gentlemen here.
In my view, gold is the worst investment which you can ever make. The problem with the gold is that if you put 1 kg of gold for eternity, it will remain as 1 kg. It will not generate more income out of it, unless you have some schemes where you are able to lend the gold to the jewelers and earn some interest out of it. Otherwise, gold remains as it is.
But the value could go up, even if the...
Yeah, now I'll come to that. Why the value could go up? Because you feel that there will be enough fearfuls in the future who will come and buy the gold from you at a price which you have bought. Suppose if you have bought at 30,000, you will feel that in future you will find enough people who are willing to pay more than 30,000 for the same 1 kg of gold.
Okay, if everyone thought like you, then the finance minister would not have a problem with the current account deficit. One voice here, then I want to get one voice from the back. Oh, now there are too many hands. Yes, that one gentleman back there, then I'm going to have to leave it there.
You've spoken in detail about equity and gold and real estate, but would you suggest any other form of investment for someone, let's say around medium risk,
for someone to invest in beyond these three main classes?
It's going to be okay. Last comment. I'm afraid we are flat out of time. Yeah, gentlemen.
We've seen what the property bubble did to US economy. So with many experts believing that it's around the corner in India, do you still want the investor who already find it difficult to invest in real estate to bring all their money, leave aside equity and gold and put it in real estate?
Okay, I keep saying it's the last comment. Let's get one lady in at least.
I'm an MBA student and I'll probably start earning next year. So now given that my retirement is too far away and I have no kid to take care of immediately, and given the market situation, I would like to take a very informed decision. Now what kind of investment suits me at this junction when I really have very low risk and a lot of time?
You just heard them giving you all the expert gyan. There could be no better gyan than you've got. Okay, that gentleman, and then that's it.
The economic downfall that we are talking about and the current election that we have next year, wouldn't I play safe till the next year and wouldn't indulge in any investment till that time where I exactly know what the scenario is going to be?
Okay, do nothing for a while. Sit on the cash until we know what's going to happen and what's happening in the election and who's winning. So let me get final thoughts from all of you. Maybe in 10 seconds, if you could sum up what you feel the immediate strategy should be.
See, I think elections or a forex crisis or economic, this is going to happen now, is going to happen next year. So I stick to a path. Be boring and I think you will make money.
Be boring and make money.